Good morning, traders. Steve Ganz here. I'm going to do a compare and contrast trade here today. This is going to be a bullish trade in FedEx. Now, FedEx has earnings tonight, December 19th, after the close of the market. So, why a bullish trade? Well, let me show you what my thought process is here. If we take a look at a chart of FedEx. Now, this is a daily chart here, and we take a look at what's happened in FedEx in the last earnings cycles. Here, we've got a gap. After earnings, we gapped up. Then here, earnings, we sold off down to here, gapped up the next day. Earnings, gapped up the next day. So, is that going to happen here? I don't know. But FedEx, they had a major miss quite some time ago, took a huge drop. Since that time, they've actually had gap ups on their earnings. So I'm going to play this as a bullish play at this point. So why do people do earnings trades? What's the benefit of doing a trade around earnings? And let me stress, this is all going to be paper, should always be paper until you fully understand and have a good sense of what you're trading, how you're trading it, etc. But the reason is volatility. Volatility tends to be much, much higher just prior to an earnings announcement. And when volatility is higher like that, it basically means that there is some fear in the market or fear around this particular stock, and people are buying insurance on it. If you own FedEx long and you think that there might be a possibility that it would drop or gap down on you, you'd go out and buy insurance on it. Just like if your house were going to, in the way of a firestorm or something like that, you're going to make sure it's insured, or in the way of a flood. So similar situation here with stock. You're going to go and buy insurance on that if that is a fear of yours. So that drives the volatility up. People pay more for the options. The other one is greed, of course. People will pay more for calls if they think it might gap up. But there's a multitude of reasons to buy insurance for, or to buy the puts. You can buy puts because you think it's going to go down and you're making a trade, a bet, if you will, on the down move, just like you would make a bet on the upside for the call move. So both of those are trader moves, but then you have the investor move. The investor move is just the protection piece. And of course, nobody's going to protect their underlying investment against going up. So therefore, there's usually a lot more activity on the put side. But we're gonna look at two different types of trades. They are both a bullish trade. The first one is going to be the bull call spread here, okay? Not sure why. There we go. So we're going to look at the bull call spread and the bull put spread. So one of these we are going to pay a debit for. Okay, we're going to pay up $362 for the call spread, and we're going to take in $434 for the put spread. Note that I'm doing both of these centered at the 280. So I'm buying a 280 call, selling a 290 call in the case of the calls. And in the case of the puts, I'm selling a 280 put, and then I'm buying my protection on that put that I sold short so that I don't have unlimited risk at 270. So both of these are $10 wide spreads. Our market is a little bit below 280 right now, but it's pretty close to 280. So that's why I centered on the 280 price point. So let's just take a look at these two and kind of what's happening in them. So right now you're going to get a little, you're going to pay a little more debit. The amount of your risk in this trade is what you pay for the call spread. Whatever you pay for the call spread, that is your maximum loss. In this case, if of course FedEx were to drop in value, you could lose the $360, $70 or whatever that you paid for that particular trade. Well, excuse me. Over here on the net credit side, you're taking in $405 by selling this put and buying that further down put. However, your risk here, the 412, is the maximum you can make. That's this amount here. You can lose as much as roughly $600 in this trade. So what's the trade-off for that? Okay, if I'm looking at the two of these and one of them I can lose more money than I can make, or I have a profit that's higher in one than the other, well, it's going to be your chance of profit. On this one, I have a 42% chance of profit. On this one, I have a 60% chance of profit. So why do I have a higher chance of profit in one versus the other? Well, we're already trading at 280, okay? So when we're trading at 280 on these two different types of positions, if the market doesn't move, if the stock doesn't go up, doesn't go down, in this case, this is going to decay away on us, okay? It's going to lose value, and it's going to lose it very, very fast after that earnings announcement comes out tonight. These options expire on Friday, so come tomorrow morning, if the market did not move, you're going to see a very, very rapid decay in those options. Same thing over here, but over here, decay is working in our favor. So that's where if we come in here and I look at the second piece of the puzzle here, I look at my Greeks, okay? Now, everything that you're seeing here, you should have in the base level free version of optionstrat. But if you start looking at the Greeks, you need to have the paid version. If you're going to be an options trader, this is critical information to have, in my opinion. So the things we need to look at here is we need to look specifically, the deltas are about the same, so not a huge difference there. The big number that's going to vary is going to be theta. So theta is the amount of decay that's going to happen in those options. And you notice on this side, it's a negative number. It's going to work against us. So if the price of the underlying stays the same after that announcement, this thing is going to decay very, very rapidly. Now I can move my, my slider here so that we can kind of see what that decay looks like. So, you know, it may be like this at the end of the day today. Tomorrow, after the news comes out and volatility drops considerably, we're going to see that move very, very rapidly. Again, if nothing changes, that's going to move down very, very rapidly. Where over here, let's just go to about the same period in time, which is, tomorrow afternoon or whatever, volatility drops here. Note, that works hugely in our favor. So as soon as that volatility drops, again, if we are short theta, that's going to work against us. If we are, the call side is going to work against us. On the put side, if the market doesn't move and implied volatility drops significantly, it's going to work greatly in our favor on the put spread. So these are the two different, these are two different potential trades that you could consider if you were bullish and you wanted a defined risk trade. So what I'm going to do right now is I'm going to save both of these trades and I'm going to share them in the link down below so that people can copy them into their platform and see what these things do tomorrow after the open of the market. So let me just get these. So this is the bull call spread. We're going to save trade and copy that link. And then this one over here, we'll save this trade and copy that link. So I'll share both of these links in the description down below. And this is just educational content. This is not a live trade. This should be a paper trade. But let's see how this pans out then after the earnings announcement tomorrow. So that's it for now. Take care, everyone.